Do you buy the bounce in equities? Opinion increasingly divided. Sylvia Jablonski, the CEO and Chief Investment Officer of Defiance ETFs, joins us now. The company has around 1.6 billion in assets under management. Sylvia, which side of the fence do you sit on, bull or bear?
Good morning. I'm a bull here. I think that there are a lot of opportunities right now in the market with inflation where it is and, sort of where it will go in the near term. Locking in investments in cash essentially means locking in losses. So I think that equities are essentially the place to be. You definitely have to spot pick. I'm not sort of just bullish the whole market, but I am bullish that there are a lot of investment opportunities right now, and there will be some fear of missing out for those sitting on the sidelines.
Sylvia, I think it's pretty consensus here that higher commodity prices, specifically higher oil prices, are probably here to stay for a little while, at least for the next couple of quarters, going at least into the winter. Talk to us a little bit about how that factors into the market. Do you think there's going to be some sort of resistance that's developed against these commodity shocks, essentially?
I do think that there's going to be an impact because of commodity prices. And what happens is that when you have these sustained inflation reads, particularly with food prices, oil and energy prices, that does actually impact the consumer's wallet, right? And then the consumer begins to have this waning sense of personal wealth, and then that dictates, whether they invest and whether they spend. However, these issues are due to a very specific situation going on in Russia and the Ukraine. Inflation was arguably on its way down prior to this. And we hope that once we get resolution here and can move forward here, that, the issues that we're going to see with oil, energy, wheat, nickel, some of the things that we've been seeing pop on a daily basis will subside. But overall, there's another, there's sort of a bigger picture out there. I think that the rate hikes have been priced into the market. I think that inflation pretty much is priced into the market now too, and will probably come down in time, provided that, sort of the war intentions don't get worse. And you have pent up consumer demand, consumer spending, good jobs, 2.7 trillion in savings, strong individual balance sheets, corporate balance sheets. Corporate spending is going to go up. So, I don't think we're going to have a 50% rally or just a raging bull market, but I do think that the economy is going to expand, and equity markets are likely to show that in prices towards the end of the year. So buying on these dips could certainly pay off towards the end of the year.
Are we back to the situation, Sylvia, where, and this is very much from a sort of top-down macro point of view, there is no other alternative but to buy stocks? Commodities are all over the place. The risk that you run in terms of the volatility, absolutely enormous. Bonds, we see yields going higher. It feels like it's a one-way street right now. Does that just leave you with equities? Are they just the least of the worst option here, or is it something else?
I think that's a great point. And in my mind, they are sort of the best option out there. And, they're a strong option, though. So when you look at, a couple of weeks back, what was going on, we saw things like the reopened stocks that hadn't done anything in a really long time starting to really bounce. You had, the Marriott, the Southwest Airlines, the Royal Caribbeans, sort of that reopen trade was really starting to pop. And then geopolitical tensions came in and pulled some of those names back. But they were outperforming the S&P 500 up mid digits. Some of the FANG names that have just been absolutely beaten down. If you think about, the future and some of the disruptive technology and secular trends that we're seeing, like Web 3.0, it's hard to believe that the 5G names like the semiconductors, the NVIDIAs, even the Verizons and the AT&Ts that are going to benefit aren't going to have a bid here. It's hard to believe that Apple, that was at 180 and can essentially increase costs to the end consumer on their goods. They have sort of loads of cash, CapEx, touching everything from augmented reality to services to actually consumer discretionary. Microsoft, Amazon, for me, the list goes on for these mega tech names that are high quality, well funded. I think that they really have a chance to run here towards the end of the year, and investors might be looking at 10 to 20% returns in those sectors if they're willing to wait it out.
Sylvia, I think that's the key word, if they're willing to wait it out, which is something that seems kind of something that we haven't seen in the last 2 years, especially with those monster gains. I'm curious, though, what are your kind of risk factors to your view? If you're bullish on the market right now, what would change that?
Well, I think worsening tensions in Eastern Europe could be an issue. The China factor, how that sort of plays into the mix. So geopolitics is the biggest one. I suspect, my view on the Fed is that Jay Powell sounds quite hawkish, but he also sounds reasonable. He keeps saying things like, in relation to the economic risks, in relation to what we're seeing happening in the markets and the economy. So maybe, there's a sense that the Fed put is not going to be there to the degree it was before in terms of liquidity in the market. But I also think that, the Fed is unlikely to put himself sort of in a corner and risk a massive recession as well. So I do think that we'll see some cautious moves there, even though we have the seven hikes priced in. But those are the risks, a deviation.
Sylvia, you talk about a massive recession. What about a mild recession? Does that in any way knock your argument off course?
I don't think, it's sort of, we have to define what that would be. But I don't think that slowing economic growth, meaning the original forecast of 4% going down to between 2 to 3%, is that, right? So I don't think that this really changes my outlook and the likelihood of my prediction playing out.